Happy March.
Thank you, Kiah Haslet. Happy March to you as well. Happy birthday month, if I may be so bold as to wish you a happy birthday month.
Oh my gosh. I thank you for the birthday month wishes. I am not a birthday month person, and I actually think those people are kind of a menace. So hot take, but I will take your birthday wishes. We are recording before my birthday, which is
Yes.
the end of the quarter. I always like to close the first quarter on a strong note.
There you go.
And I'll be at CBA for the first time on my birthday, in which I will be demanding birthday wishes and telling people they have to give me let me have my way that day.
So I'm sorry. So just to be clear, you're not a birthday month person, but you are a birthday day monster who just like goes around and terrorizes people.
If I can get my way and manipulate people by any means, and I think dropping one day out of 365, I will use my birthday to manipulate people.
Got it. Well, I think that's fair. I think that's totally fair. I'm also surprised to hear that you've never been to CBA Live before.
That's correct. Yeah.
That is amazing to me. I will say I'm not going this year because I will be at FinTech Meetup. Kiah, I guess in some senses you joining FinTech Takes was about us being able to divide and conquer the industry. And so this is a good example of that. I am jealous.
You're choosing to go to Las Vegas instead of choosing to go to San Diego.
I'm not. I want to be clear. I'm not choosing that. I got involved in a bunch of what I think is going to be great content things at FinTech Meetups. I'm excited about that. I'm excited to see people who I know are going to be there. It's going to be great. I don't like Vegas. I've made that abundantly clear. It's in San Diego. CBA is in San Diego?
I think so. Yeah. I mean, that's, I think, where I booked my flight to. Yeah.
Damn it. I love San Diego. So no, that is A, that is disappointing. And B, I am jealous because apart from the location, CBA Live is great. I always tell people like when they're like, hey, what's the conference I haven't been to that I really should go to? CBA is awesome. Like everyone, particularly kind of from the larger end of the banking spectrum. So like regional banks, national banks, like very senior people doing interesting things or just walking around the show floor, just happy to chat. It's awesome.
Yeah, I was pretty impressed with the speakers, which don't ask me because I don't have it up right now, but I was kind of impressed by who the keynotes were. So
Yes. No, it's a good group. The content is good. Our friends at CBA put on a good show. I think one thing that's beneficial about it is that they have the associations as a part of like the overall association that sort of spend all their time like working on the content for the show. And so those people who participate in the association really make the show what it is. It's awesome. So I will eagerly look forward to getting a report back from you on both how CBA Live went, but also how your birthday and terrorizing people on your birthday went. Yeah.
Man, I feel like I'm such a bank nerd, like I can't really always turn it off.
I've noticed that about
in my life. And to have, the quarter one birthday, you can always make a couple of finance jokes with that. But to be at a banking conference on my birthday is, I think, next level. So it's it's accessing a whole level of nerdery that I haven't have previously heretofore not been able to reach.
I am very excited for you. If anyone listening is going to be at CBA Live, like do what you can to make Kiah's CBA Live / birthday special, because that will be quite the event. Kiah, we're recording a bit earlier than we normally do in the month.
Significantly earlier. Famously working ahead is how I'll say this.
Which if people know the two of us will know that was a you idea, not a me idea, because I'm not a big work ahead guy. But I am very excited to talk to you because many, many things have happened and we have on our agenda like topics we haven't maybe spent as much time talking about recently. So I'm excited about that.
Yeah. So hopefully, because we are recording so far in advance, hopefully no giant bank failure happens in the next 2 weeks. That's
been known to happen around this time of year.
Yeah,
with
actually
us
in this month.
Yeah.
Famously, but I wanted to talk about a little bit of news that is new to us, but won't be new to our listeners when they hear this, which is the, drumroll please, first crypto firm to receive a Fed account or Fed master. I don't even know if we should call it the master account because it's not the full account, but received or had their application for a Fed account approved, and that was announced recently. That firm is Kraken.
Yes.
And the Reserve Bank that approved it was the Kansas City Fed.
Mm-hmm.
And the account is a limited account that doesn't have the interest or the reserve balances, but does allow them to um, access Fed wire and move money directly. And then
Mm-hmm.
the account, I don't want to say it's probationary, but there's like kind of a year, like the
I saw
account will
that.
be reviewed within 1 year.
Yeah.
And there are other restrictions and tailorings. However, the application is not public. And also the Fed is not going to list the other, what else, if anything, Kraken will have access to. So, Alex, what is your
Ah.
reaction to this news?
Oh my goodness. Well, so skinny master accounts are now a thing, which is kind
I
of
did not
crazy.
realize. We have to talk about this, but yes, go on.
Well,
Go
so
on.
I guess my high level take is that in some senses we knew this was coming directionally, right? Because there has been a push from I think starting from the top. So like Fed Governor Waller has kind of been working and publicly workshopping, and sometimes publicly sort of somewhat retracting what he suggested before. The idea of a more tailored way for certain firms, still qualified under the law, to access certain Fed payment services without getting the whole ball of wax. And as you said, this is for us, this just happened. So I'm sure there'll be more details released on exactly or reported on kind of what this entails. But it sounds like the basic idea is that, as you said, they're going to get access to sort of core payment services operated by the Fed rather than having to go through a correspondent bank, which is typically how these things are accessed when you don't have a master account. And, the argument for that is that you are both sort of lower cost in your access to this because you don't have to pay for that correspondent relationship, and you don't have to filter any of like what you're doing through that correspondent banking relationship.
Right.
And so you're less at risk of being cut off by some intermediary that decides they don't want to be in that business anymore, they don't want to work with you anymore. You have one less kind of person you have to check with when you're kind of deciding what types of payments volume you want to process. And particularly if you're a company like Kraken, that is very payments oriented, and payments is kind of a core element of your business, you could understand why touching the metal, so to speak, in kind of developer terminology, would be attractive and something that you would want. So all of that makes sense to me. Kiah, I guess a question I have for you is like, is this a true master account that's a skinny account? Is this what Fed Governor Waller had proposed before? It seems like this happened pretty fast. Like, I feel like we just talked about skinny master accounts as like an
Yeah.
idea, and now here
Right.
we have one.
Right. So, close listeners of the pod will know that literally last month we talked about this issue.
Yes.
And we talked about it because at the time, the comment period was closing.
Yeah.
And we talked about how, like, no one likes this proposal. It's not enough for some firms. It's too much for traditional banks that are the tier ones. And I think everyone kind of assumed that from there, the Fed would closely read every single comment and then synthesize something. You'd hope that they'd publish a rule that
I
said,
thought they were going to do that. Yeah. That's typically how these things work.
yeah, you just literally anything. Comment period
Because
closes.
the proposed rule was published just for timing purposes on December 23rd. This is like a Christmas present for us.
Yeah.
December 23rd of last year. And then the comment period, as you said when we talked about this last time, closed on February 6th.
Uh-huh.
And they got about 70-ish comments received from the industry. And then they read those comments really fast and then got an application from Kraken and then approved that application by March 4th. And I said
Right.
those last words somewhat in tongue in cheek because I don't think that timing that's a month. That's less than a month.
Yeah. So the question is your question is this a skinny account? A lot of people in the reporting today are calling it a skinny account, but of course we don't know because we don't know
Sure.
what skinny accounts will entail because
the
skinny
rule's not
accounts
published. Yeah.
like my understanding was they didn't exist and
Yeah.
the Fed was saying, "Hey, if we were going to build a skinny account, what should be like what do you think of including these things and excluding these things?"
Yeah.
And then like then they would probably, I would hope that they would say formally, a skinny account is this, it is not this.
Yes. They have not done that.
They haven't done that.
Yeah.
And I don't know if they have to do that technically,
Yeah.
but people are calling the Kraken account skinny without actually I don't understand what includes a skinny account entails. And also, I think what's interesting too is the Federal Reserve Board in DC put out the proposal and collected the comments.
Yes.
But the Fed Reserve Bank in Kansas City is the one that approved this charter. And I'm not 100% sure about the coordination mechanism between the board and the Kansas City. Oh, I should have brought my St. Louis Fed.
I know. I have my Kansas City Fed mug.
I can't believe we didn't coordinate our mugs for this recording.
Little prop here for us. Yes. No. So that's a good point. And I guess it gets to something that I'm really confused by, and maybe like Fed watchers who are listening can clue us in on the details here. But to your point, it's a little unclear to me how the Fed's, let's call it like rulemaking process works. And it's something that's always been mysterious to me with the Fed master accounts and has been the subject of a great deal of controversy is like, how do they exercise the discretion they have over who gets these accounts? Like, I mean, it was not that long ago, Kiah, that, and probably involving quite a few of the same people at the Fed, I would hazard a guess. It wasn't that long ago where you'd submit an application as a qualified institution who was like legally allowed to apply, and you just wouldn't hear back for months, for years. Like, I mean, we were not that far away from like that being kind of the on the ground reality is just, hey, we submitted one, but like it sort of seems like they want us to just withdraw it because they're not saying anything and we're not getting any feedback. And now Kraken, again, to your point, there's no details on like the application, so we don't know when it was submitted or what was in it. But like this all seems to be moving much faster. And I guess a question looking into the future a little bit is this the Fed saying, all right, we're going to try one, right? So one plausible interpretation of this would be something like,
that's a good explanation.
Let's just say, right? So like Kraken, they have the Wyoming special charter, right? That's the one they have.
It's not a national trust charter, importantly, not a national trust charter.
This is the goofy state of Wyoming custody crypto charter thing. So they have one of those. Let's just say, theoretically, that they applied a long time ago. They've been kind of front of the line, just waiting patiently. And the Fed, under sort of the guise of like, hey, we need to be more friendly to payments innovation, we're considering this skinny master account, blah, blah, blah. Why don't we just approve this one, kind of conditionally, as you said, like with this 1 year period? We'll test it out. We're not throwing the door open to everyone. We're still working maybe on finalizing the skinny account and then publishing what we think that actually is and defining it and saying, usually when you publish like a rule or a proposal, a proposed rule that becomes a final rule, you have to explain, like, we read the comment, this comment we agreed with, this comment we didn't agree with. You have to kind of rationalize all that. So maybe that's all coming. And then in parallel, they're also doing this as a way to like learn and test and experiment and blah, blah, blah. That would be one theory of the case. Another theory of the case, and again, Fed watchers can call in if they want to correct any details I'm getting wrong here, but like another theory would be something more like, yeah, we could wait to finalize the work we were doing on the skinny master account, or a different branch of the Fed, right? Like a different part of the organization could just jump ahead of all of that work and start giving out sort of skinny master accounts in name, even though we don't know exactly what that is. And this is the first of a bunch that are going to come rushing through the door, kind of reminding me a little bit of how the OCC has been dealing with National Trust Bank charters, just like boom, 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 like let's go, go,
or
go.
Or the FDIC and the and industrial loan. Right.
Right. So like there's a bit of a pattern in other parts of the bank regulatory sphere of just, no. This isn't like a conditional experimental one thing. This is the door is wide open. We're not even really going to mess around with like publishing new guidance or rules or giving any sort of public information. Just apply and we'll say yes. At this moment in time, as we are recording, I don't know which of those two doors we're talking about here.
Yeah, it's interesting. And it must be said that the first charter went to Kraken and not Custodia, which is
tough beat. Talk about someone who's been standing in line for a long time.
Right. And the other thing I think will be interesting too is, so you mentioned this comes from Wyoming.
Yeah.
I wonder if the unstoppable duo of the Wyoming specialty charter
Yeah.
and the Kansas City Fed, which is Wyoming, I believe, is in the district of,
Right.
are going to be where we see a lot of this activity happening.
Mm.
Maybe, I mean, it would be interesting if the New York license went to the New York Fed, and that's a New York firm was able to get an account through the New York Fed. That would be maybe the other district, or maybe San Francisco if there is a specialty charter in, like, I don't know, Nevada or something.
Sure. Someone else who wants to be like a crypto place. Yeah.
But yeah, it is interesting to see if this like Wyoming,
Mm.
Kansas City duo is going to come back, or if like you can just apply for Fed master accounts in any reserve bank.
I honestly, I don't know, but that's kind of one of the things about the Fed that I find so fascinating is it's so decentralized relative to other banking agencies, right? Like most of them are like, we're the OCC, we do national banks, we do it across, like it's just like it's a very like centralized, relatively straightforward sort of organization. The Fed is, and you know this having visited one recently, like it is spread out across many different districts. They all have sort of slightly different remits. I mean, as we've talked about in the past, some deal more with payments, some deal more with like a Fed Now versus checks versus Wall Street. Like they all have kind of different remits that they focus on, and so I am really interested to see like is this decentralized thing going to be the way that they deal with this, or is one group going to be in charge of evaluating all master accounts? I don't
Yeah.
know.
Yeah. And I did just check. I had to check myself really quickly because the Fed
The
passed
districts are
the
wonky.
the Mississippi River are really
Yeah.
weird because
Yeah.
Kansas or Missouri somehow got two feds.
Nah.
So yes, the Wyoming is in the Kansas City Fed district. I was worried for a hot second, one, that there was a Fed in Denver because I couldn't remember, and then two, that it was actually in San Francisco. But we're all good. We're all good on the on the active live fact checking. But yeah,
Excellent.
it will be really interesting. And I wonder too if this kind of changes the calculus around the trust charter.
Sure.
We have seen more applications come in for the National Trust Charter beyond World Liberty. Morgan Stanley applied for a trust charter. I was surprised to learn Morgan Stanley doesn't already have a trust. You would think that a $1.4 trillion company in assets that has been named a SIFI since FSOC was founded would have a trust bank. But I guess they didn't. And they have waited until March 2026 to get one. And and it's going to be for crypto. I guess it'll be for their wealth customers that didn't need the trust bank before. And it'll be for crypto. And that I thought was really interesting. But then Stripe subsidiary Bridge and then crypto.com got their conditional charters. And then Payoneer got applied last week. And I wonder, one of the calculuses was this would make it easier to apply for a national or for a master account or a skinny master account.
Wasn't the theory, and you know the tiers better than I do, but wasn't the theory that getting a national trust charter, even though you're not getting like FDIC insurance because you're not taking deposits, it sort of puts you in a slightly higher position than like
two. I think it's tier 2.
Whereas like the Wyoming one is tier 3, right? Like state, no FDIC insurance. So it is interesting, right? Because like again, Kraken, why them? Like why Wyoming? Why this state charter? Why a tier 3? Is this actually a skinny master account? Like there's a lot of questions, and it would be ironic if all the work to get, like, imagine that like national trust charters, the main objective was we want to get a master account. And in a perfect world, and Stripe actually said as much in some of their public comments about the skinny master account proposal, like we don't even really like the idea of like a skinny master account that has all the bells and whistles stripped out of it. Like, Bridge is becoming a national trust charter sort of ostensibly to try to get like the full kit and caboodle.
The full one too, yeah.
Yeah. I mean, it has more value sort of bundled into it. it'd be ironic if like that's still sort of like a soft no, like, we're not really wild about that. But if you're coming from Wyoming and you're state chartered and you apply with the Kansas City Fed, like, I mean, it's just, it opens up these weird questions about why this. And again, between now and when this episode publishes, it's entirely possible that 14 more of these will have been approved and this will be out of date. But at this moment, it does seem odd. If you'd force me to bet which company was getting one of these first,
yeah,
I don't think.
What did Kelshi say about this? You know,
Yeah, that's a good question.
Who was gonna get theirs first?
Now, see, damn it, that actually would be a good use case because then I could like hedged my risk and done the whole thing. So no, I wonder about that, and I do think going back to the other point I was making about Stripe, I think there is still this question about how much value a skinny master account has versus just a regular master account, and as more and more of these crypto or crypto adjacent companies or payment companies apply for national trust bank charters or what have you, like it's just going to create a larger population of people who are technically qualified for the full thing. And then the question for the Fed will be, okay, which of these companies do we think are actually a good fit for a full master account?
Yeah.
Which of these companies do we not think is really fit for a full master account? Do we have an alternative, like a skinny master account, that we can push them to that is like has published characteristics that people understand? And will all of those companies be willing to accept that as an alternative? And I think all of those questions are ones we don't know the answer to yet.
I agree, and I also think this. I wonder if long term the Fed's interest in awarding these accounts and who they're active for like creates a de facto national money transmitter license. And
that's CSBS music I hear in the background somewhere.
We're just gonna like kind of back end into this thing existing and not actually have a fight about it. If you can be a tier 3, but get kind of prove to the Fed that you can address whatever its concerns are for the privileges of accessing, like maybe we're closer to a narrow bank now, and maybe I can get a Fed account, and you know what I mean, like
I do,
right? So
yeah, the narrow banking thing is interesting because I do think, and we've talked about this in previous episodes, but like national trust bank charters being repurposed as more like payment oriented entities has been one of those things where I've been like, that feels very narrow banking-y.
But yeah, like tell me how some of these, I mean, this is so not about Kraken, but tell me how some of these national trust banks aren't narrow banks. And like, I'm not offended by a narrow bank. So like, if, GECO is kind of pretty close to a narrow bank, it seems like sometimes, because, they turn all the deposits into treasuries. So
Erebor is kind of narrow banking-esque, and they only makes loans to
Erebor is a narrow bank in so much as they don't understand maturity transformation. So...
Well, their chief risk officer left, so that might be an indication. Kiah, I guess the flip side to this whole conversation is if we are welcoming in the era of narrow banking entirely, who's going to do the maturity transformation? Where is the liquidity going to come from for lending? Kiah, can we talk about private credit?
Yeah, I think that if the banks are only good to put all the money in fully reserved securities, the people who are going to be in charge of the lending have to be private credit, I guess, or shadow banks.
That's the theory. So I don't know that we've talked a ton about private credit before on the show. So let me give a little primer. Is that okay?
Please.
Okay. So private credit. Let's just work our way down the market. So let's start with the biggest corporations. Company like Coca-Cola, let's say. Corporations at a certain level have no problem getting access to money. They can easily borrow money because they're very large public companies. Their balance sheets are very well understood and stable. They also have the ability to sell corporate bonds. So they have lots of ways of raising capital when they need it. But Kiah, what about middle market companies? Especially middle market companies that are needing more sort of change or financial support in order to be the best possible version of themselves. Companies that go through private equity buyouts or dividends or recaps or acquisitions. Those companies are capital hungry. They need money to execute these strategies and to do these things. But they're also much riskier. They're oftentimes private. They're not well understood. They
Okay.
work in different sectors or different verticals. And again, the amount of money that they need to borrow relative to their earnings is much, much higher than these large public corporations. So after the great financial crisis, bank regulators decided, not so much based, I think, on like actual rules or regulations, but more just on guidance about let's not go too crazy, that they didn't really like leveraged lending, meaning when debt levels are above earnings by some ratio. And uh, nominally, I think 6x EBITDA was sort of the informal threshold for like, if you're
Okay.
doing leverage lending beyond that level, we, your prudential bank regulator, are not comfortable with you doing that. That change, which again came out of the great financial crisis, along with other more structural changes like tighter capital and liquidity constraints, caused banks to basically pull back on serving these middle market businesses. So Kiah,
Right.
suddenly there is a gap in the market. We are not going to loan money to these kind of riskier mid market businesses. Into that gap steps private credit firms.
Which are
And
other, yeah, like they just need lenders, right?
they just need lenders. So these
Yeah.
private credit firms are just private non-bank lenders, is I
Yeah.
guess a way
Okay.
to think about them. And what they do is they go out into the world and they find like long-term, patient, stable sources of liquidity. Pension funds are very popular. Endowments are very popular. Family offices are relatively popular, and they will use their money. And again, you have to think about it as very patient capital because you're trying to replace deposits fundamentally as like a funding source, right? Like we are going to make loans to these companies. These loans will pay out over a long period of time. But like if I'm loaning money to a mid-market company that's going through a acquisition or is being merged into another entity or rolled up by a private equity firm or what have you, it's going to take a while for the value of that to prove itself out. So we go get this patient, long-term liquidity where people don't need their money back right away, and we invest at better and more flexible terms than what banks are now kind of constrained in what they can do for these middle market companies, especially again those being acquired, grown, refactored by private equity. So the growth of private credit can be seen very much as sort of mirroring the growth of the private equity space, and they're kind of these two parts of the market are working hand in hand to wring more capital and wring more revenue out of these mid-market companies. All right. So the private credit space globally has grown over the last 10 years from about $500 billion to roughly $2 trillion and is expected to keep growing at a very significant rate. Um, so it's been growing a lot, again, largely as a response to both the need for capital from the market as well as banks sort of stepping back from this space.
Okay.
However, all of this competition in private credit, whenever you have growth like that, again, $500 billion to $2 trillion, you tend to bring in a lot more activity. So there have been a bunch more firms that have gotten into the private credit space, and concerns are starting to crop up about fraud.
Love that.
Concerns are starting. I know it's your favorite thing. Jamie Dimon's cockroaches comment was very much directed at private credit specifically, and then concerns about credit quality. And the question is really, are private credit investors taking shortcuts on underwriting and risk management in order to win deals? The problem, of course, and I'm going to hit another hot button for you, is that we don't know because private credit firms don't use fair value accounting.
Amazing.
So
What
nothing
could go
is
wrong?
marked to market. We don't know about the quality of these loans. It's really kind of opaque. And they can tell sort of whatever story they want about credit quality. And as long as their investors believe them, they're good. And as long
Yeah.
as there's no like evidence, like blatant evidence of fraud, which obviously we saw some examples of things breaking where there was fraud that just, I guess, couldn't be hidden anymore. As long as those things aren't true, you can kind of continue along. However, there have been signs, and again, I think some of those fraud examples, like Tricolor and some of the ones we've talked about before, are sort of maybe the catalyst for this. There have been some questions recently from investors about, yeah, how good are we feeling about private credit? And there are a couple different examples of this, a couple different reasons for this. One of the ones that I think is interesting is just the concern that the private credit space may be a little overly exposed to the private equity space, and a lot of PE-backed companies aren't doing super well. Particularly those that were sort of like financing or making deals prior to 2023 when interest rates went up. Like
Right.
there's a lot of
Yeah.
you can think of private equity as sort of similar to lenders where they have like vintages of
Yeah.
companies that they buy or invest in, and those pre-2023 vintages are not doing well. You remember those days. Like that was not a particularly good time for commercial real estate, for a whole bunch of different things, and PE is not spared from that. There also has been, and I'm sure you have seen some chatter about this, the recent like SaaS apocalypse, meaning like really sort of big drops in SaaS software companies' stock prices, and
Right.
a lot of private credit and a lot of private equity has been focused in SaaS and software, which is normally considered, I think, to be a little safer, even for
Yeah.
leverage lending, because software is such a like durable, profitable, high margin business. But now we have like AI coming in. Block just laid off 40% of its staff, saying that intelligence would allow the company to operate much leaner than it has historically. Like that's true across all of SaaS and software. Everyone is freaking out that like AI is going to completely change the structure of those businesses. So all of that is kind of spooking private credit investors who are exposed to all of these different areas. Last thing I'll say about this, Kiah, is two things. One, in December of 2025, the OCC and the FDIC formally withdrew
Not a moment
the
too soon.
no, a moment too soon, the leveraged lending guidance that they had put in place in 2013 after the Great Recession,
Right.
which is the guidance that had spooked a lot of banks to stay away from leveraged lending. And Vice Chair Bowman at the Fed has recently been talking about the need to give banks more flexibility in order to compete in lending against non-bank lenders. Now, her comments were more specifically oriented towards the mortgage space, but you can sort of draw a line and see like regulators right now believe that banks have been sort of unfairly pushed out of this space. They also, I imagine, are seeing these same results that we're now starting to see in private credit, where investors are getting a little bit more spooked. And then the last bit that also very much relates to banking is that a lot of private credit growth very recently has also been funded by retail. So, as I was saying before, most of the money in this space comes from life insurance, pensions, annuities, things that have like very patient capital that sort of have these structures where you like insulate retail away from the risks. And so it's like, oh, I don't worry about my pension. Someone else's job is to worry about that. So, like, whatever they want to do is fine. And I don't really see it. I don't really care. Versus 401ks or other types of like more retail investment structures where as they are getting more involved in private credit, there's more sensitivity because
Uh-huh.
like while I don't care about my pension, I do care about my 401k because it's my job to monitor my 401k. It's my nest egg and I think about it in those terms. And so scary headlines about private credit withdrawals, or there's been some stuff with like Blue Owl Capital where they had like a surge in withdrawals for their a specific fund that was focused on retail, and they actually had to sell some of their assets in order to facilitate redemptions. There are sort of things that rhyme with bank
Yeah.
runs happening
Yeah.
there, and that's all because the source of capital and like how private credit has evolved as it's grown. So, Kiah, how was that as a primer for
No,
private
that
credit?
was
Do you feel
great.
totally caught up now?
I feel like we haven't talked about this topic because banks have ducked or they are senior lenders in many of these situations.
They've
So
like retranched themselves out of this, and now
yeah,
they might loan some money to a
they
private
might loan.
credit firm,
Yep,
but they're
to Blue
senior in the
Owl.
stack. Yeah, yeah, yeah.
Yep, and um, and you're right about the guidance from 2013 about leverage lending, and so banks kind of excuse themselves from much of this space. And it is interesting to see what we call non-bank financial institutions, or NBFIs, step
hmm
into this void.
hmm
I think one of the things that has been so interesting is to kind of try to figure out how big the space has gotten and why it has gotten so big. Like to go from 500 billion and quadruple it in 10 years seems significant. And in banking, I think that a regulator would have a lot of questions for an institution that had quadrupled its asset size in
Totally.
10 years,
Yeah.
and will ask, like, where did you find this growth? How are you ascertaining that you're making kind of the same types of loans, or how has your risk appetite changed, or how have you changed your borrowers or your funding base? I think private credit is something that's great, is that hopefully they can get rid of some of the maturity transformation risk and align the funding closer to the duration of the asset or the
Yeah.
loan.
Yeah.
Um, it doesn't work if you allow redemptions, and I am kind of fascinated by if your deposits are, or the
Mm.
funding is not on demand. How do you decide how much money to return every quarter? Because you have to return some of it, unless it's like fully locked up,
Depends on the
right?
structure. Some are like very locked up. Some you sort of return it on a very kind of gated, sort of
Yeah,
structured path, and so it depends on the structure. But the problem, again, going to your point, is there's only so much of this out there, right? And that to me is one of the things I always.
conceivably there should only be so much of
Well,
this out
right,
there,
right. I
right?
mean, that's the thing I always think about with these things, and it doesn't matter what we're talking about, right? Whether it's private credit or private equity or whatever, like there's only so much demand for borrowers. There's only so many opportunities for private equity firms to invest or acquire companies, and there are only so many opportunities for private credit investors to get that patient, structured, long-term capital that's predictable. And then once you get past that point, you basically have a problem, right? Which is, okay, either we've sort of saturated this market and we just
Yeah.
need to be kind of okay with that,
Yep.
or we need to find ways around this to find more demand and to find more sources of capital. And I think, yeah, to your point, like about the quadrupling of this asset size over the last 10 years, the thing that I would wonder about as a regulator, and it's funny because bank regulators, I
Well,
think,
which
are
regulator
curious.
too should care
Well,
about
that's the
this?
thing.
Yeah.
That's the thing is like whenever I talk to bank regulators about this, they're like, "Yeah, I'm looking at private credit, but I'm not going to get fired if it blows up, right?" And so it's like not
Right.
really my problem. I'm curious about it, but it's not my problem. And in fact, when you listen to like Mickey Bowman speak, she thinks about private credit more as like not only is it not my problem if it blows up, but it's an opportunity for banks to get in there and to stake some of this market share away. Like we want to make banks more competitive
Hmm.
with some of these other, asset classes and some of these other types of lenders. And I do think it's a interesting question about like how would banks be doing this differently, if at all, is a question I wonder about, right? Like it's not like banks don't have fraud and cockroaches hiding under things that they do. These large deals are very hard, right? Because it's like
Yeah, it's like
they're
some of the
bespoke.
frauds are ABLs, asset-backed lending. It's a little
Yeah,
different than what SaaS lending probably, right?
right,
So,
right. There's different categories, right? So you can invest in a software company and like loan them money to grow. You can loan money to a private equity firm to roll up a bunch of smaller firms in one category. You can loan money to a fintech lender who then lends that money out to consumers or small businesses. So there's a lot of different like forms that it takes, and each one of those different areas has like this is the other thing about it is they all have specialties, right? Like doing private credit lending for asset backed finance is very different than private credit lending for like AI data centers, right? And
right,
like
right.
so all of these different ones are very different. So in some senses, going to your point, it's not very useful to talk about private credit as a thing because it's just well, all we mean by private credit is non-bank lending to
Non-bank,
anything.
yeah.
Yeah.
Yeah. I also, one of the notes I have in here is like, is it good or bad banks aren't like like kind of they're upstream, they're a senior
Yeah.
lender in
Yeah.
all of this. And 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 I would argue that, like, to the extent that the 2013 guidance was to tell banks that, like, actually this, doing some of this lending or to some of these companies, or for some of the revenue structures, it's just a little riskier, and that, like, we're not 100% sure we understand the risks. So if you're going to do this, you're going to have to, like, put a ton more capital up against it. or whatever. And
It's like your
so
spouse giving you like constraints if she knows you're going to Vegas. It's like, yeah,
exactly.
like
Yeah.
we just, like the
Yeah.
history of you doing this is not great. So like, here's a limit, and like you can't go past
And
this.
like, do I think it's like terrible that the banking industry couldn't get in on some of this quadrupled ass? No, I think actually, like, I'm like, that's crazy. That's
Yeah,
obviously growing too fast. They're
yeah,
obviously cut. I mean, to me, I'm like, so obvious that this
yes,
is not going to work out. And the question is like, I don't think it's going to be $2 trillion
no,
not working out, but like there might be painful losses, and some of these are going to be straight frauds. Do I think it's
yeah,
great that banks missed out on that? Yeah, like I think it's kind of crazy that we're,
yeah,
some of the stuff we're seeing. So I think it's to the extent that the regulators were in 2013 were just like, we just don't think anyone has a handle on this. So what we're not going to do is put insured deposits
yeah,
involved in these loans.
yeah,
And then for that there to be credit weaknesses and then a potential like they're trying to, some of these redemption requests are
yeah,
kind of trying to run. And the
yeah,
question too is like, the way that these leverage lending firms are meeting the demand isn't with capital. It's they have to sell off the assets. Like that's a fire sale. Like
yeah,
doesn't anyone understand how Lehman Brothers failed, right? And so and then, there was like a question about some of the like people who run these companies having put their own personal stock up to
yeah,
borrow against, and now there
yeah,
might be a fire sale there. The other thing I think is really funny is that this kind of came up when we talked about SVB and the risk of uninsured deposits and the run
yeah,
risk,
yeah.
and that you were like the biggest fan and proponent of certificates of deposit.
I love
And
them.
the question, I think it's useful that the
Hmm.
funding is locked up, but I think there are hazards of locking your money up, and which
Sure.
is that like you kind of can't pull it out. Like you're if you're in for like you're in, right?
Well,
So
and they have like legal mechanisms to like basically not allow redemptions too,
right,
right? Which is like that's built into this structure. Like private credit and different funds are different, right? Like if it's more of a retail oriented
yeah.
one, they do allow for more redemptions.
Why did we expand to retail?
That's the thing. That's the
we
thing is that
that
like
was probably
it's
the beginning of the end right there, right?
yeah. Well, and I going back to the question you asked about, is this good that banks haven't been involved in this? I find that such a fascinating question because on the one hand, I totally agree with you, right? Like,
Yeah.
banking should be boring, and the more sort of novel and leveraged and high risk it is, the less fun I'm having as someone who lives in the American economy and like wants good things for myself and my family. But I will say the flip side to it that's interesting is I was talking to a credit risk guy who's worked in kind of credit risk, consumer credit risk for a long time, and we were talking about the credit card space, and he was like, we were talking about, yeah, is credit card starting to crack? Like, what's happening here? What are the signs with the delinquency or whatever? And he
Mhm.
was like, yeah, there's some mild yellow flags, but there's nothing like that's glaringly obvious as a red flag. And I was kind of asking, like, well, why is that? Because, like, balances are really high. Delinquencies have ticked back up to pre pandemic levels. Just the overall level of debt is really high. And obviously, like, affordability is really like crunching consumers' kind of balance sheets. Like, why aren't we seeing this? And one of his theories that I thought was really interesting was he was like, look, all the credit cards are concentrated in the hands of like 6 credit card issuers who
Yeah.
really know what they're doing. And he used the phrase like steady hands. Like it's just steady hands who know exactly kind of how much to turn this dial this way. They have the appropriate mix of like caution and sort of aggressiveness in terms of lending. They have a lot of like scar tissue built up having been burned by this over the years. And so like the market just doesn't spin wildly out of control because the hands are relatively steady.
Sure.
And I do wonder with private credit if the fact that banks have been sort of excluded from this market, on the one hand,
Mhm.
it makes banking a lot safer, but on the other hand, it makes private credit much more dangerous. And the question is, like, if banks had been involved in it, I'm sure they would have grown private credit the same way that it's grown now, maybe not as much as we've seen, and maybe slightly more carefully. And the reason I think that's important is whenever you swing one way, you swing back very hard the other way. And the
Yeah.
question is like, and I'm not saying this is likely to happen, I don't know. But like with private credit, if there was a much more sort of significant issue in private credit where it kind of broke and then like there was sort of like run dynamics where like the market really sort of contracted, obviously that's not going to hurt bank depositors, so that's good. But like that would affect private equity firms, and that would affect the companies that
Oh
they've
no, who
invested
will think of the
in.
private equity
Well, no, I
firms?
mean, I could give a shit about the private equity firms, but like it'll affect software companies. It'll
Yeah.
affect, it'll affect like plumbers whose companies have been rolled up by private equity firms into a combined, like it'll affect the economy in a
Yeah,
way.
the
And
question is
I'm
how
curious
much
about that.
I think you're getting at this question about um the what like I like to think, hopefully, a
Yeah.
plumber or a software company has a revenue stream
Yeah.
and needed some sort of financing to support something about that revenue stream, but the financing is not 100% relevant to like the revenue stream is not dependent on the financing.
So if someone loses, is it the plumber or the software company, or is it the private equity firm or the private credit firm?
Private
And like
credit
to your
and
point, if it's
yeah.
private credit and private equity who get wiped out, like that may be sad. Oh no, you know what I mean? Like, is that the worst thing in the world?
Well, and the other thing too, and like I want to be also really clear, I think private credit grew in the last 10 years in part because of the low yield environment. So we
Yes.
have investors, I wouldn't want a pension fund necessarily to take losses on this,
No.
but the pension fund was interested in this type of asset class
In a low
because
rate
of
environment.
the yield on it. And so what we
Yeah.
had was someone deliberately seeking out risk, and we don't have enforcement mechanisms quite like we do in some of the regulated spaces about mark to market or fair value, or heaven forbid setting aside allowances, right? Like I my understanding, and I'm not going to investigate this so someone can go do it, is that like Blue Owl also has to follow CECL because if they use gap accounting. And I don't know what the mechanic is for private companies, but like that's not a bank regulator rule. That is from the accounting board. And so there are mechanisms that Blue Owl could do short of like withdrawals. And so like the same discipline can, the private credit can use the same tools that banks
Mm.
use to manage credit risk. The question is like, did they already take the risk? Is the risk already baked and we're just hoping it doesn't crack? Also, like, are they taking losses because they made loans to frauds, or are they taking losses because the credit underwriting assumed a different financial environment, a different interest rate environment, a different revenue environment than we're making? And then you can maybe revisit, maybe try to get them to refinance out of your book,
Yeah.
which
Work
banks do
out
all
some
the
of these
time.
ones. Yeah.
Extended for 10, that's a thing that happens. And so it is interesting because, like, I think private credit, hopefully they've done good for for the economy. Hopefully we get all these data centers built.
Sure.
All the AI companies get all the private money they want, and they get it from investors who want this risk and understand exactly what the trade-offs are. And that, like, anyone who gets burned by it understands that they were playing with fire, right?
Yeah.
Whereas I think in banking, what we didn't want was people signing up for mortgages they didn't understand, signing up for mortgages under essentially fraudulent conditions,
Sure.
and then the systemic nature, the like rippling of risk through the industry, hastened by runs on banks.
Yeah. No, I agree. I mean, I think one thing that I think is pretty demonstrably true is that banks are great like vectors for spreading risk when things go bad, right? Like
Yeah, they're
when a
all
bad thing
connected
happens
to
to a
each
bank, it's
other.
like you just like it's really that's why, we spend so much time and brain power trying to stop that from happening. I agree with you. Like I think a lot of what's happened in private credit, like not all of these loans are going to be great, but for the most part they're being made to entities that generate cash flow.
Yeah, they're
Um,
real.
they're real, and they're insulated from depositors. They're mostly insulated from retail. I do worry about Matt Levine's been writing about this a lot in Bloomberg lately, like the whole private markets or the new public markets concept. And I do worry that retail is where all the money is. And so, like, eventually these markets will find a way to find retail, whether it's changing the rules on what 401ks are allowed to invest in or like whatever the mechanism is. Like there will be lobbying to try to find ways to get retail involved in these. And so that, again, that comes back to like where I start to get concerned about consumer harm. Even if it's not bank regulators' job to stop that from happening, it should be someone's job. And so it's not without risk, but I agree generally that like, I mean, in some ways, I think this was a huge policy win over the last 15 years of just like, we're going to retranche banks out of this, and this can be the domain of other people. Like that makes sense,
I also don't think any of this was inevitable. That it doesn't. You don't have like you can have banks out of leverage lending, and you don't actually still have to take the amount of risk or have the amount of growth that we've seen. And so, at a certain point, like if I don't know, a quarter, a 20% of the leveraged lending doesn't work out, like I don't, like probably that's just probably market risk. Like that's just probably economic and financial risk.
Yeah.
And I don't think that devastates the industry. I also think we're so like not used to seeing credit losses anywhere. And so we're very sensitive about like 5% withdrawals.
We're like, I mean, everyone is, I think everyone's very on edge, and you've written about credit cracking and that kind of stuff. Like I think everyone is just very on edge for any signs of danger. But yeah, looking at this space, it's not like I see like, oh my God, we are imminently going to have some massive bubble that collapses. I mean, AI is much more likely to be the cause of that than private credit, I would say.
Which again, like, then make a different choice. Like, know? So, actually, can I talk to you about a very banky thing, a very banky topic?
I would love it if you would. Yeah. What are banks doing? If they're not allowed to invest in any of these leveraged loans, what are they doing?
Well, one bank that you might have heard of, Chase Bank.
JP Morgan Chase.
Yes, Chase Bank. Okay. So that's their consumer retail arm.
Got it. Yep, I've heard of them.
Have you heard, like, they're the largest bank in the country by assets. I believe they have the most amount of branches.
There's one branch in Bozeman, Montana, I will say, just as like a little, I know, we're very excited. It was a Pier 1, and now it's been converted into a Chase branch.
Oh, that's a really big bank. Okay.
It is pretty big, yeah.
They are doubling down on branches in the year of our Lord 2026, Alex.
Okay.
Chase came out recently with plans that they are going to open one branch every 3 days this year, which I think is kind of crazy. So that's 160 branches. They are going to be concentrated in about 30 states. So it's not across the country. They already have 5,000 branches. So they're looking at North and South Carolina, Florida, Pennsylvania, Kansas, Massachusetts, and Tennessee. The bank is aiming...
Tennessee, there you go.
I know. We'll talk about that. The bank is aiming to be within 1 hour drive of 75% of the U.S. population, which I think is kind of crazy.
The U.S. is a huge country, so that is a goal. That is goals. Yeah.
Right.
Okay.
And where they're opening these branches is based on client migration patterns, input from local staff in areas where they already have branching.
Client migration patterns, I'm sorry, it makes it sound exactly like Native American tribes following buffalo like across birds. The land. That's what it feels a lot like. Yeah.
They're also, to staff these branches, they have to hire more than 1,000 employees.
Wow.
And so they would have 10,000 people working in their consumer bank by the end of 2026.
Wow.
Apparently, 1 million Chase customers visit a branch every single day. And they are this is part of their long-term plan to capture 15% of the U.S. consumer deposit market share. The bank also shared that in the past 5 years, new branches have driven like their market share gains, and investments in their branches break even within 4 years. Now, I think this is interesting. And I think this is interesting because it kind of flies in the face of, I think, a lot of what we see in where banks are investing these days and what channels. But I also think it's interesting to contextualize this 26 news against what happened in 2018, which was that in 2018, or prior to 2018, Chase Bank was rumored to have been under a matters requiring attention order with the OCC. And one of the conditions of that order was that they couldn't open new branches.
Okay.
And there's some reporting on this. It's getting like harder and harder to find stuff on the internet now, but I did find the Bloomberg article where they
Okay.
talked about how in 2019 the bank was going to be expanding again with branches. So
Mm.
so 2018 this order lifts, and 2019 Chase begins opening new branches. Chase, I think, has to open branches, has to use a branching strategy in part because they are not legally allowed to acquire banks through live M&A. They can obviously bid on failed banks, but
And they have.
yeah, they're under, I think they have, when you have more than 10% of the nation's deposits, you are not allowed to participate in M&A unless the regulators really, really need you to participate in it. And so if you think about post-financial crisis, Chase probably would have had WAMU branches to kind of figure out and work through. I believe Chase had presence in some of the markets where WAMU was based. And so those were probably like density plays, not expansion plays. Then they go under this MRA. And then in 2019, it lifts. I actually moved to Nashville in 2019, and I was at a different big bank for my deposits. As you know, I'm a really large Chase credit card customer.
Yes.
And so Chase opens, I believe in like maybe 2020, 2021, branch really close to where I live. And like there's just more in Nashville.
Mm.
Something that's really interesting, and I'd like to ask you about your Chase branch, is that many, I'm going to say more than 75% of the new Chase branches in Tennessee, because Tennessee is an expansion geography for them, are near Chick-fil-A's.
Oh.
Is
Now,
your Chase
how
bank?
do you know that? Is that just, did
What
you
do you
do
mean?
the
How do I
research on
know
that?
it? With my
Did
eyes,
you?
I know it.
So
Like,
you just, this is anecdotal Kiah on the street doing the
yeah,
research, noting
Kiah
locations.
sometimes has to go to a Chase bank in order to withdraw $5 and $1 bills for when I'm traveling. Or
Okay.
if I've received a physical check, sometimes I'll just like drive it to the bank and deposit it.
Because you don't have a smartphone, so that
Well,
makes sense.
I was like, I was at, like, I would have worked a game and received the check. Does that make
I
sense?
see. It
So
does.
then I
So
could just
like,
like go
I'm not on
home.
the road. Yeah, I
Yeah.
got
Or
you.
like
Okay.
sometimes like I go to games, I'll referee games, and instead of checks, they'll give me cash. And so I'll have like hundreds of dollars of cash,
Yeah, what are
which
you
I
gonna do
will
with
always
that? Yeah.
deposit. I'm
Okay.
that kind of person.
Sure.
And so I have noticed that many of these branches and someone told me that Chase open, like someone told
I've
me this
heard this
theory.
too. There's a
Yes.
theory. Yeah.
That, and I might have, like, someone told me and then I've just propagated it for several years, but it's true in Nashville.
Well, you just said it as if like that is a known fact as confirmed by the like New York Fed or
I don't
something.
think Chase would ever confirm this for me. And if anyone from Chase wants to like off the record confirm that it's true,
Yeah.
I have a couple of theories. The Chick-fil-A's in Nashville are older because Chick-fil-A is a Southern brand, right?
Yeah.
And so it's
Not an expansion market for
It's not the
Chick-fil-A's.
expansion market.
Yeah.
And so I just think this is really interesting
Yeah.
that Chase is going on such an offensive.
Yeah.
And I was wondering, what are your thoughts about are branches cool again? Is Chase making branches great again?
This is a great question. All right. Well, so I'm happy for the people who are going to be working jobs at Chase branches.
Yeah,
That's
congrats.
great.
Yep.
So we're happy about that. I mean, I'm a fintech person, I guess you could say, in my heart of hearts. And in fintech, this notion of building branches in 2026 is not like common knowledge or a way of thinking. Most people think of customer acquisition or even customer retention more as a function of like digital and digital experiences and, whatever that might mean in the year of our Lord 2026. I guess my thought on this whole thing is that Chase isn't stupid. We should start there, right? And so, like,
I'll agree with that. Yeah.
I mean, like, say what you will about Chase, and I can and have said plenty, but like, not dumb. And so, this strategy is clearly based on data. It's clearly based on a very rigorous analysis of like what happens when we open a new branch. How long does it take us to pay back the investment to do that? What does it do in terms of either density for retention against competitors or for expanding into a new market? We're hiring people locally and like the effect of being able to bring in deposits by doing that, like clearly it works, right?
Yeah.
And one question I do sometimes ask as like a hypothetical, just to keep myself intellectually honest, is if I gave Chime, let's just say, JP Morgan Chase money and said, what do you want to do with it? They might build branches, right? So it might just be the answer is if you have enough money, really still the most effective way to acquire and retain high value customers in particular. And that could be defined as sticky, non-price sensitive deposits. It could be defined as customers that start small businesses. It could be, the owners of large commercial enterprises that also want to have their commercial relationships with Chase. Could be private banking, could be any of the above. Maybe branches are actually still the most effective way to acquire and retain customers. And the only reason we talk so much about digital is that digital allows for much smaller, less well-resourced institutions to punch above their weight and to get into the game and compete. But if you gave them unlimited resources, they'd be doing exactly the same thing that Chase is doing. So I think that's a theory worth considering. I will say personally, just to fill out my side of the anecdotal evidence that you already supplied, I don't go down to the branch very often.
Okay.
I do like having a branch nearby for my primary banking relationship. I bank with a community bank, but I haven't sold out to the big banks like you have. But because I think
some of us move and we have like interesting financial relationships and 13 credit cards. So
that's fine. I just happen to believe that community banks are the soul of America and America's heartland, and I support that. But whatever,
I know you talk about that all the time. Yeah.
Yeah. It's all good. Not everyone feels that way, but I do think like branch proximity and customer service and some of these things do still kind of enter into it from my perspective. So it's not even in 2026 something that I find completely like difficult to believe or outrageous. I guess, Kiah, the question I would bounce back to you is, when is Chase going to stop? Like what and this kind of
so there's one bank in America.
I know. And if they can't do it through acquisition, then damn it, they'll do it organically by just like, it's a little bit like this ecosystem can only support so many organisms. And if we just build our branches on every street corner, can we just choke the life out of every other competitor? Another question I might ask with this branch strategy, and Chase would never say this publicly, but I wonder if we can like intuit an answer to it, is who are they doing this to? You know what I mean? Like, we're expanding into this market. Who are we trying to take from? Who are we worried about? And Jamie Dimon talks a lot about fintech and talks about Silicon Valley is coming and they're going to eat our lunch and we have to do all these things. He says that, but the way his company spends money, it would seem as though what they actually are concerned about are these regional banks who are starting to muscle into our territory. And you see this with like the Fifth Thirds and the PNCs and like those types of companies that are also less well-resourced than Chase, but are also expanding through branches. And so I wonder if there's a dichotomy between who Jamie Dimon tells investors on earnings calls he's concerned about and who he tells his team internally when they're making resource allocation decisions, who he's worried about.
Okay, so I have a couple of thoughts. One is I shared a bunch of Chase news with you, but I didn't share like what some of the research shows around branching and customer types. And I think this has been mostly looked at from what I would say is an insured deposit, which we could probably ascertain means retail depositors.
Sure.
That and I have issues with some of this research because it felt like they knew what the result would be, and so they were kind of backing into the research that in the as interest rates rise, there was a potential relationship between the amount of branches a bank had and the stickiness of the deposits, which meant that they had a lower deposit beta, and lower cost of funds, and so
they don't have to compete with stable coins to offer yield on deposits. Yeah, I got you.
And I kind of argue with this because the biggest example of this is that SVB had 10 branches and had a $100 billion deposit run. And I think it's kind of specious to say that if SVB had 100 branches that they wouldn't have a $100 billion deposit run, but there's a relationship I think that's important between branches, retail accounts, and retail accounts is just a stabilizer in both rising interest rate environments and in times of bank stress. Now, does that mean that everyone should open branches so you can get a bunch of really small dollar accounts.
Mm.
No, but I think that that's just it's a useful hedge, I
Yeah.
think.
Well,
The
and
other
Chase
yeah,
Chase treats its balance sheet like a fortress. That's kind of the language
famously.
that is used to describe it. Yeah. And fortress, you think about defensibility. You think
Yeah.
about like, what do we do if this changes? So it kind of fits that mental model.
Yeah. The other thing, and like Chase is like a business bank, an investment bank,
Sure.
and a retail bank. Not every single bank is like that. SVB famously wasn't really a retail bank. Now, the other thing I think is really interesting is where they're building, and they're building where they don't have presence. I think we can say that, but also I would suspect that where they're building has better demographic trends than places where they're not building. So Chase might be building branches because in 30 states where they don't have a meaningful presence, but also where they expect to see deposit growth over the next, let's say, 20, 30 years. And what I would
This is that
argue,
following the herd mentality a little bit. Like, where do we
yeah,
think people are
I
going
mean,
to go?
like, I think they're kind of going after some of banking in the Southeast because this is a
Yeah.
very vibrant economic market.
It's growing. Yeah.
And what I would also I'd like some research on this is the amount of like familial relationships
Mm.
that start in a branch. So
Yes.
I remember you took your
Yes.
kid to a bank to open
Yep.
their account, even though like I don't know if you could have opened one online or over the phone,
I
but
think
like
we could have. Yeah.
okay, so I think there actually might be something to this generational demographic idea of like let's get where the young families are
Yeah.
growing in
Yeah.
their exurbs, right? We're getting
Yeah.
like
Yeah.
further and further away from Nashville.
Yeah.
And let's get their kids an account. And if we're everywhere when that child goes to college, then the child will keep their account and we'll have this like young adult and we'll and like we'll have a customer for life. And we just have to make this investment now even if the child, like, comes into the branch once a year, right?
Yeah. Yeah.
We're still that kid's bank, and if we meet all that their needs everywhere they move in the country, because they'll be an hour away from every single branch or not every single branch, a
That's right.
branch. I think there's, like, maybe something to that, like, I
I
don't know
think
if
that's
Chase would
true.
also ever articulate, but I think that, I think about I don't know if banks are always thinking like, "Hey, long term, like, how many people are gonna live in this town or in this state in 20
Well,
years?"
and like Chase is the type of bank, given its size and its sort of level of sophistication. Like, I'm sure they have 100-year plan of like, this is what's going to happen,
To
and
become the one bank, yeah.
this is how we're going to dominate this century. So like they probably think in very long time horizons, as you're saying. And I think the reason the branch conversation is fun is that it does kind of invoke these ideas that are more about the psychology of how people think about money and safety, and the connection to a physical place and to people who work in your community, who like
Mhm.
when I go into the branch, I mean, one of the things I value is being able to like joke about how my college football team is doing and like commiserate or celebrate or whatever. I
Alex.
mean, like, no, I mean, like,
So lame.
I know that's kind of trite, but like, it's not totally untrue. And going to your point about like, kids and opening up accounts and families and stuff, like, I want my kids to think about money tangibly. And it's hard to teach people about money when money is not only digital in terms of how it moves around behind the scenes, but how it presents itself to you in your day-to-day
Yeah.
life. And that was one of the reasons I wanted my kids to like, I want them to touch and feel money and think about it in a tangible sense, because that's important. And I think it helps them learn about it in a different way. And I'll just say, as kind of maybe a wrap up to this topic, this is a strange thing to bring up, but it kind of reminds me of it. Did you see the video after the Super Bowl where Coinbase had the ad with the music, the karaoke ad, and there was like a video of like a group of people watching it, and they were singing along to it
Yeah.
and doing all this stuff. And then at the end, Coinbase's logo came up, and everybody booed.
Yes, I've
And
seen a video where
yeah,
that
yeah, yeah,
happens.
it's pretty awesome. But the thing that's funny about it to me is like, I wonder to what degree Coinbase only existing as an app on your phone and not in any other tangible way impacts your perception of it as a thing, right? Because it's not like Chase has a universally great reputation. You know what I mean? Like Chase is this super large bank. The average American consumer is not like the biggest fan of bankers as a profession. They're not like widely admired or necessarily even trusted, especially since the Great Recession. Like, I don't think Chase has like amazing branding, but I think they have tangible branding. And I think they have like a solidity to them that is aided by all these branches. And you can't, no matter what community you move to, there's a Chase branch. There's something about that where it's like, if I see a Chase advertisement on television, I'm not going to clap and I'm not going to probably laugh.
Or salute,
I'm not gonna, I'm not going to salute. Like, I'm not going to do anything crazy, like positive, but I'm also probably not going to boo when Chase's logo comes up. And I do wonder if the tangibility of branches and the relationship with brand matters at all. And that would be a question for people who study this stuff more than I do.
Yeah, it'll be interesting, I think, especially, again, as everything becomes more digital, everything's more app-based. Who needs tangible money? Why is the idea of tangible money important? And how does that kind of change over time? And then to see like, well, right now Chase has like the largest tech budget of any financial institution.
Yeah.
And they could probably do endless things with that money. And one of the things, they're doing out of their whole operations is they're investing in branching. Which is silly because we'll be using stable coins this time next year. So I don't actually know what they're going to do with those like 160 branches.
Well, I mean, all the trillions of dollars will disappear. So
Right.
yeah, I mean, the branches won't have much happening in them if the fear around stablecoins is to be realized. Kiah, can we end on that topic? Can I give you one more?
I think so. Yeah, and safe travels for your March.
Oh my gosh, I appreciate it. It's going to be a very, very busy month. I don't think we're really going to see each other in person this
Not
month,
until
but
I think New York FinTech Week.
yes, in
End of
April.
April.
So so if people are going to be at that one, definitely look us up. But be out on the road and looking forward to talking to you again soon.
All right, talk to you soon, Alex.